Last week, Canada's job report numbers for January came out, and the numbers were surprising to say the least. With 150,000 new jobs added, the report exceeded the forecast by 10 times. And that got everyone talking about what this means for our economy and what this means for interest rates. So in this video, we'll be breaking down the details of this report. But before I go on, check this out. This is a heads up that you can get our complete Toronto real estate investing guide for free on our website. You can see things like a breakdown of typical costs, rents, appreciation, sample financials that you can change up to see how it affects your returns, and even try out a quiz to see what might fit you best. I'll put a link to the free guide in the description below. Don't forget to like this video and subscribe to our channel so you don't miss other content like this made just for real estate investors in Toronto. The January jobs report showed a staggering 150,000 new jobs added. But where did all this job growth come from? The big change actually comes from non-landed immigrants. Take a look at this chart. While the other categories actually saw a drop in employment since the summer of last year, 2022, non-landed immigrant job growth actually skyrocketed. When you think about this more, this is actually in line with Canada's population growth in 2022, which saw the fastest population growth in over 50 years. Now that these people are settling in, they're now getting jobs and contributing to our economy, which translates to this huge job growth. Now, it's important to note that job growth from the sector fell in 2020 when immigration gates shut down. So in a way, we're playing catch up with this demographic right now. This job gap catch up is also happening to our US neighbors, and if we take a look at this US payrolls chart, you can see that there's still a bit of a job gap, close to 4% in the US. We don't have this chart for Canada, but BMO tells us that this job gap is certainly also around at 1% in Canada. The next thing I wanted to highlight is a seasonality factor that has been stripped away with this data, which can actually throw things off in this current market. That 150K job growth number is the seasonally adjusted number, which is definitely the way to go in a normal market. By stripping away seasonality, we usually see the real economic impact more clearly. But we're not in a normal year with normal seasonality trends, and so stripping away normal seasonality might not actually present the most accurate results. And just so you know, the non-seasonally adjusted job growth number actually dropped by 125,000 jobs. Next, you should keep in mind that there may still be changes made after the release. For example, December numbers were revised downwards. Originally, the December report showed a growth of 104,000 new jobs added, but after the revision, it now shows 69,000 new jobs added. It's still very big, but definitely not as big as the first release. Moving on, let's dive into the job sectors that have seen the biggest growth. I talked about how the job growth mainly came from non-landed immigrants because our population is also increasing. And because of this, these people also boost the need for more jobs in certain services. Take a look at this chart that breaks down where jobs came from. It mainly came from the private sector and full-time work, but more specifically in these associated industries: accommodation and food services, information, culture and recreation, and even construction. And so once we put more things into context, this job growth number starts to sound a bit more normal. I think it really comes down to monitoring wage growth more closely at this point, which ends up directly correlating to the sticky service inflation that we've been experiencing. Even though the number of jobs is still rising, a slower pace of wage growth can indicate a shift towards job growth in lower wage industries and may eventually slow down service inflation, and we're seeing early signs of this. The BOC acknowledges that this is and will continue to be the toughest to gauge, and so they'll also be monitoring this closely. So what this means is that the uncertainty is still pretty high at this point, especially since we continue to see big surprises in the jobs data. One thing, though, for sure is that it doesn't look like we are on the verge of a recession just yet. And BMO, who predicted that we would enter recession in early 2023, has now pushed their forecast further out. Right now, they're forecasting moderate growth in GDP this quarter in Q1, and then a mild contraction in Q2 and Q3, and eventually a rebound in Q4 of 2023. Now, we know in January, the BOC said that they're going to be temporarily pausing rate hikes, and TD doesn't think that this one jobs report is going to change their mind in March. Now, beyond this, it would be a tougher call, and it would depend on where inflation and job numbers go in the coming months. In the best case, we might end up seeing that soft landing that the BOC is targeting, with inflation coming down more, even as job numbers look strong, because we're still playing catch up with demand, and we might still be hiring to cover a higher number of sick days compared to pre-COVID. In the most likely case, and this is predicted by many forecasters, is that we would see a recession, but it might end up being later and less painful. And perhaps that's why businesses are still hiring, because they don't think the recession will last too long. Just keep in mind that the worst case is still possible, because the BOC is stopping rate hikes prematurely and dragging them out. We might end up seeing a later, more severe and more prolonged inflation situation, which means we would see higher interest rates and more pain. Now, hopefully, we will see that most likely case, the fact that high interest rates are likely close to the peak and will stick around for most of this year. And in this case, we don't expect demand for real estate to change drastically this year as a whole. But if you focus on fundamentals, the numbers can still make sense with Toronto freeholds in today's market, because we are seeing very strong rental income and, yes, still positive cash flows at these high interest rates. On the appreciation side, you might not see as much in the short term, but once interest rates come down and prices start to recover, you'll also benefit from long-term appreciation as well. So, if you want to learn more about these opportunities, let's chat.
We're a real estate sales brokerage that focuses on investing in houses and multifamily homes in Toronto, and here's how it's like to work with us. First, we'll do a discovery call with you so we get to know each other more and help you get your financing ready, and then we'll teach you how to analyze deals. Once you're set, our sales team will work with you to find the best opportunities on the market and eventually help you buy the best one for you. Houses typically need a bit of renovations, and we'll help you with a detailed scope of work and contractor connections. And then once you're ready to rent out the place, we also have leasing and property management services if you need it. So if you want to learn more about any of this, just head over to our website at the link down below. Again, don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. You can also head over here to check out our other videos. Thanks so much for watching, and see you in the next video.